welcome to the Restructuring, Consolidation, and M&A panel. We're very lucky to have a distinguished, I exclude myself, but a distinguished panel of experienced experts on the shipping sector, in the shipping sector, and who will address a few points and questions on a very wide-ranging topic, as I'm sure everybody can see. Just real quick to introduce, we have Mr. Floris Lyppens, who is Managing Director and Head of Corporate Finance and Equity Capital Markets at ABN AMRO. We have Kevin O'Hara, Managing Director at AMA Capital Partners. Mark Friedman, Senior Managing Director at Evercore. And Chris Weyers, Managing Director and Head of Maritime Investment Banking at Stifel. So I appreciate the panelists joining us for this panel today. We'll probably end up going in a couple of different directions since this is a pretty wide-ranging topic. And I think some of the panels that we've had beforehand set the stage a little bit for where the money may be coming from in order to deal with what are, I think, always a changing environment in shipping in terms of restructuring, consolidation, and M&A opportunities. So to tee it up, first, over the past several years, as I think everybody knows in the sector, that the different sectors in shipping, different segments of the market, have suffered severe downturns. And a number of companies have needed to restructure, both in and out of court. We've seen several of the traditional shipping banks exit shipping, and that's a topic that's been discussed over the past year and even here today. And the capital markets have become very selective in accommodating issuers. So with that backdrop, I'm going to ask each of the panelists to address what prospects they see for consolidation in some of these different sectors and compare and contrast dry, tankers, containers, and offshore drilling, the most recent sector to suffer quite a bit. Floris, you want to kick it off?
Yeah, let me just say, in general, consolidation makes a lot of sense. There's all the economic reasoning is there, and you would expect that a lot of consolidation, it's already happening, but you would have expected much more. And without going into detail on each sector, what we have seen in certain deals, and actually what I heard in the previous panel as well, is that yes, it makes sense to merge, but many times you have the owners and management who are just not ready to merge. It's the egos. I saw that in an Evercore presentation as well a half year ago. That's still a big thing in M&A, and many times I think, like, why it makes all the sense in the world if you guys go together or if you divest, but the egos are still an important thing.
You mean the bankers' egos?
The bankers' egos, absolutely.
Ah, I didn't know they had egos. Okay. No, we're talking about the owners' egos.
Yeah, indeed, the owners, yes. Right. So, yeah, it makes a lot of sense. It's just, it should happen much more than what is going now.
Kevin?
Yeah, I mean, it's a good place to start, right? There's shipping and offshore is pretty unique in that sense. It's a very colorful industry. You have plenty of owners who are very proud of what they've built. But when you look at the offshore sector, you're actually starting to see a little bit. You see the Norwegian companies coming together, and there's some big names in there, certainly, where you might have had that as an obstacle in the past. So it's not going away, but it's certainly changing a bit. One of the other things I think of in terms of a major obstacle for offshore restructuring is the idle equipment. You know, in shipping, you typically see in a downturn you could still run your vessels. You might be losing some money on it, but here you have cold stacked vessels, and that cost of taking those idle vessels on and funding them until, God willing, there's a market upturn at some point is probably one of the largest obstacles we're facing right now.
Mark?
Thanks, Bill. I guess I've always observed the tremendous fragmentation in the industry and really little barriers to entry and really little reason why you can't fit assets together, and this really goes across different sectors. So, you know, one of my lines I've used are, you know, fleets fit together a lot better than management teams. And so, the ego point that you raised, I think, is a very valid one. And so to see consolidation come together, it really does need to be largely shareholder driven. And there's certainly a lot of companies where, whether it's private equity ownership or just illiquid stocks, there's a real justification for consolidation. I'd say, the number one reason for consolidation is really driven from an equity capital market perspective. Of course, there's some operating synergies and the like, but when you cut right through it, you have this series of micro-cap companies that really on their own have very limited investor interest. I thought Kevin from Team Tankers spoke well about it earlier, and he was bold enough at the end to say we should put the 4 public or semi-public companies together, and he sort of touted together they would have $1 billion market cap. Well, even for most investors, $1 billion is a very small company. So the big picture is really a capital market synergy along with putting together something that has, sizable scale and something that can really captivate investor interest.
Chris?
So I guess I'm up now. So I would agree, pretty much completely with what Mark has to say. I think, we've seen a lot of M&A activity this year relative to past years. Most of that M&A activity, appears to have been, liquidity driven, essentially shareholders looking to get more liquid in their ownership positions. And, liquidity's, key amongst all of the public companies. And you've got this whole big group of private companies, most of which are sponsor owned. And I really put the sponsor-owned ones in their own group because all these sponsors, that invested a number of years ago, and they all thought they'd be liquid by now, and they're still not. And they look to mergers with, public companies as, maybe, one of the few paths to liquidities today because they can't go public on their own and there aren't really cash buyers. And, so it feels like you should continue to be a lot of activity. But as Mark and the other panelists have said, there's a lot of, issues around these mergers, like relative values of companies. It's very hard to get to, even shareholder groups to agree with. And then, who runs these companies once these mergers are complete is, really hard as well. So I think it needs to be shareholder driven. But, shareholders, in a lot of cases, really struggle to come up with appropriate values for their companies and the companies they're merging with, which makes this challenging. But, I guess the last point I'll make is most of the public companies today trade around net asset value, which I think is kind of where they should trade to be the most attractive M&A targets. If they trade below net asset value, nobody wants to take their shares. If they trade above net asset value, they never want to pay asset value in shares. So it makes it more difficult. But, given everybody's at NAV today, in theory, the stars are aligned where we could see M&A activity really pick up.
So let's pick up on something that I think interesting about private equity. Private equity is something that entered the lexicon in shipping 5, 6, 7 years ago as people were emerging from the crisis, first getting involved with some distress investments and then more getting involved with other investments for different reasons. You would think that the private equity players would be looking to foster more consolidation, whether through access to capital markets where others may not have it, or bank debt, whether it's from the traditional banks who are pulling out purportedly or others. Are we going to see more, or why aren't we seeing more of the private equity folks fostering more consolidation? Chris, we'll start with you and we'll come back down the horn this way.
Sure. So in my view, the private equity folks that are in shipping today typically have control of the companies they're invested in. They run them, they manage the board. They can effectively kind of tell management teams what to do. And while I think all of them, would like to exit their investments, they don't want to give up control unless they think the vehicle that they merge into is better, than what they've got today. And I think in a lot of cases, it's hard to argue that these vehicles are better because, if you merge two private shipping companies together, is a bigger private shipping company better? It may be marginally better, but not better enough for these private equity funds to give up control. And then you talk about merging into public companies. There's only a handful of public companies that have the right corporate governance and liquidity, in their shares that would make it an interesting share for private equity firms to own. So, I think those alternatives are on the table, but, there aren't many merger candidates. But, I think as a general rule of thumb, they keep looking at, is there something I can do that's better than just owning these companies myself? And so far, the market hasn't really given them any better, propositions than just continuing to own it themselves.
Well, you would think logically that PE guys could readily transact with other PE guys. That would be logical. But somehow, they, in some cases, I think they get enamored with their own control. And so suddenly, if the trade was to sell your private company to a highly liquid public company, maybe like Navigate and Scorpio, there's certainly a logic there, and that they can understand, because if they don't control it, they can quickly sell it. And to them, that makes sense. Doing a private equity sort of merger with other sets of private equity guys, sometimes they feel more comfortable. I'm not being judgmental, but they feel more comfortable sort of controlling their own destiny, even if ultimately their own smaller entity has less liquidity. And, maybe they're also having some form of, Stockholm syndrome, where, hopefully I'm not insulting anyone from Stockholm, but.
It's a nice place.
But look, they become very close with their management teams, and suddenly, they become very defensive and supportive, which in some ways is an enabler, or an inhibitor, I should say, to consolidation.
We do seem to have some history now. There's case studies out there. When we first hit this downturn, which seems like quite a while ago, which I think probably is, there weren't a lot of case studies. Private equities was just getting interested in the space in a real way. But now companies have been bought out and gone through bankruptcy, had their debt purchased by private equity, come out with ownership. They've converted their debt to equity to do so. And so you can see different companies and how they react. And I think what you'll see as a pattern that's evolving is something that Mark is alluding to here. Some of these companies might have 5 owners. And these are not quiet people. These are people that are investing for a reason. They have high personal incentives to do well with their investments. So they're not going to sit back and let somebody else run their investment. So,
Hence the ego point.
I didn't say ego. Yes, exactly.
In part.
And then you'll see a few companies that have come out with majority ownership by one private equity firm, and I think they were able to take a little bit of more of a firm direction instead of having kind of going back and forth with their partners.
Yeah, I like the Stockholm Syndrome quote a lot, because if you look through the cycles, private equity has made a less than 10% return, which is horrible, and you wonder why they're still around. And just recently we were in the market with a portfolio of assets, and I was really surprised still how much demand there is and how many bids we received for these assets from private equity. And yes, it changed a little bit. I mean, it's not only the good old standard private equity, there's also a lot like the alternative financing we had in the previous panel. But still, with less than 10% return on equity historically, I'm just mind-blowing how much appetite there still is.
So what would be the pros and cons for different market players in consolidating, if there are any cons? I mean, part of it is that they need access to liquidity, and then they want to be able to get out at a reasonable return. So do you see certain segments of the market where there's more opportunity than others? And, is there any compelling reason for or against for some of these segments? Floris?
Now, again, I see a lot of reasoning, and it's a little bit across the sectors. And of course, it's what we saw in 2 panels ago as well, is that so many of the banks are withdrawing, so the debt financing is really drying up. Nordea, DNB, Dansk, DVB, they all sort of hit their ceiling or pulling out. And actually, ABN AMRO is one of the few banks that's still expanding its exposure in the industry, which creates the good companies still get financing, and the bad companies have a really hard time to get the financing, which creates a big difference. And it's just a matter of time that these parties consolidate, and size matters. So there's a lot of sense to consolidate, to get access to these limited sources of debt financing, and that's across the sectors.
Across the sectors, okay. Kevin?
I would think one of the cons out there is something you see on a continual basis, but every once in a while you tend to forget, is how easy it is for someone to go out and build up their own fleet. As unfortunate as it may sound, the 4 of us could go out, if we had a sponsor, and build 20 dry bulkers. And all of a sudden you have another competitor in the market.
It's a good idea.
Where you have a sector, though, that's a little bit more complicated, whether it's tankers, and I think moving on up to some of the offshore sectors with sophisticated vessels, nobody in their right mind is going to go out and build a new dive support vessel and just run one by themselves. So I do see a little bit more of an opportunity in the offshore going forward, starting with the general concept of everything's darkest before the dawn, and then emerging from there. It may be a couple of years, but that's where I see the opportunity.
I guess just to reinforce, I think in general, I think you can be pretty agnostic in terms of consolidation. It sort of, to some degree, all of the sectors, whether it's crude tankers, product, chem tankers, dry bulk, I mean, they're all sort of big areas. They're all pretty fragmented, so consolidation really could make sense in every sector. And again, to sort of circle back to the key advantage, I mean, it's all about capital when you cut through it. Look, there's some level of G&A synergies. There's some level of, maybe enhanced management that you might get in a consolidation. But until somehow this industry goes asset light, which I don't think we'll see, it's all about capital. And that's really the point of putting these businesses together. And hopefully over time, if you do have a really well-capitalized company with shared liquidity and good management and responsible boards, God, that's a lot to ask, you might actually see these companies trade better and have a valuation premium, which in and of itself would be a factor that enables consolidation. And I think Chris's point is fair. Most of these companies sort of trade, within a band because, quite frankly, most of them aren't sort of differentiated in terms of their size or their capital access. I do think, just to sort of maybe transition a little bit to the restructuring, maybe where it gets more interesting is we are seeing some restructurings where they aren't just purely kick the can restructurings, and there's a lot of equitization. And we saw that a little bit in dry bulk. We saw it in the recent ocean rig restructuring that Bill and I worked on, where now coming out of restructuring, at least these companies have really strong balance sheets. And so they can now be the natural consolidators and as Kevin mentioned, you could see that in, rigs and offshore. So I think that's going to be something that's going to be interesting to follow.
I guess I would say, from, it's kind of restating some of the obvious, but I think the big cons around merger activity today is, figuring out kind of the correct, corporate governance post-merger, and the fact that there's so few companies in the shipping space out there today that have kind of proper corporate governance today for, somebody to merge in and take shares. And really and it brings me to the second point, which is, the only way to complete mergers today is through issuance of shares of equity. There's, nobody really has cash today to make cash acquisitions. So the other big constraint is financing. With the banks pulling back, it makes it much harder to finance these acquisitions. The capital markets, while they've filled in to some degree, they definitely have not stepped in to replace the banks, and the cost of capital there is much, much higher than the cost of bank capital. And then the real pros of kind of merger activity, in my view, is the longer these private equity funds and hedge funds, sit on investments they made a few years ago, the stronger their desire is to get liquid. And merging, particularly into a public company, is really one of the only avenues to get public today. So I think the need for liquidity and the need to exit investments is going to start to drive more decisions to merge companies. And then, as I mentioned earlier, I think valuations, particularly in the public company space, are pretty good to try to consummate some of these mergers today. And then I'd agree with Mark on restructurings, particularly in offshore, because that's a sector that's been restructuring. You've got a lot of companies that are coming out with very little debt. They're also coming out with, very kind of non-traditional shareholders, essentially hedge funds that bought their debt now own their equity. And a lot of these guys, aren't long-term players either. So I think within the offshore space, you're likely to see merger activity as companies come out of restructuring, whether it be two of the drillers or two of the, the U.S. Gulf OSV operators coming together. And the other driver for that is these companies all effectively, if they don't have charters in place, have negative cash flow. So they're actually burning cash, and the desire to, actually eliminate corporate costs and on the G&A line are, pretty critical in that state if you want to maintain liquidity to get to a better market.
Yeah, I think the issue of exit and liquidity is definitely a key component. Let's shift to the restructuring just for a little bit, since Mark raised it. We've had, several years, certainly, dry bulk, and now we're in the throes of the offshore, and there's going to be some other sectors probably coming down the pike. What lessons have we learned so far, and what differences are there, for example, between the restructurings that are more comprehensive equitizations and there are still some that appear to be kick the can down the road? What kind of lessons can we derive from that? Chris?
I mean, I think, probably a number of lessons. One lesson which I wish really wasn't a lesson, but, companies in broadly defined maritime space, go bankrupt, and they go bankrupt regularly. A lot of companies go bankrupt multiple times. When things get bad, they get really bad. Companies with too much leverage go bankrupt very quickly. Companies with even moderate amounts of leverage tend to go bankrupt, later if the market doesn't recover quickly enough. So I think, one of the big lessons for me is, because I started doing restructuring in probably, 2010, 11, 12, and there'd never been any restructuring in my career before that. And I thought it would be done, come 2012. And it was temporarily done for like 2 years, but then all of a sudden, all these dry bulk companies had to restructure again, and then all of a sudden oil price collapsed and all the oil field service companies had to restructure, and, it'll come back around, to tankers and dry bulk again, at some point, not too soon. So it's highly cyclical, and, for restructuring bankers, there's unfortunately a lot of opportunity in this space.
That's why here in the U.S. we call it Chapter 22.
Right. Yeah. As someone who's done a lot of restructuring, and it's a big part of our practice, I shouldn't be giving out this advice, but there's a special group. The truth is, you can't have all this operating leverage that a tanker or dry bulk company has and a massive amount of financial leverage, and then layer on a massive dividend. That's just a recipe for disaster. You don't need to be a genius to figure that one out. But, I think the companies in the sector have always been challenged with valuation. And so when valuation is difficult, you raise a lot of debt because you don't want to do dilutive equity, and to get a higher share price, you seem to feel you'll get it with a higher dividend. And so ultimately, that leads to bad consequences, and now we have a good history of that. So that's sort of, I think, the biggest lesson to be learned. The other lesson is your restructuring is going to look like who your debt constituents are. And so having done kick the can restructurings with banks that only wanted to do that, and quite honestly, a lot of the management and shareholders wanted that as well because it kept the hope alive of no dilution. So, we've seen that flavor, and there's a reason for it. And then, you tend to see better long-term outcomes where you do have more of the hedge fund guys in there who are willing to equitize, and the company will come out healthy and ready to grow. But, everyone should recognize that comes usually at the cost of almost complete dilution and wiping out of existing shareholders.
Kevin.
In terms of talk about lessons learned, and AMA has been doing restructurings. Morton Arntzen moved over and kind of recreated AMA into a restructuring shop at the time in the late 90s. But I don't think it was really seen to be a restructuring shop. But the reality is it's been 20 years, and I think all but 4 or 5 of those have been pretty solid restructuring years, just in terms of being busy with restructurings. The constant theme that we see over time is the need for actual fixes, for an operational solution. I would say it's harder these days, especially on the offshore side, but it's difficult to go in and just change the debt structure without looking at the operational side of the business. And when we try to bridge the capital markets with the operational side, that's part of what we're trying to do. And I think that's the biggest challenge these days, especially in the offshore market, when you have no home for a lot of these assets.
Right. Floris.
I've never done restructuring, but I really think we should look into this, because that might be an interesting business case for us on the advisory side. And so that's the main lesson for me.
You're a lucky man.
Yeah, no, but it makes sense, because again, all the banks that I just mentioned who are, withdrawing, they become much tougher than they were before. Certain banks just kept on kicking the can down the street. But who now start to be more tougher and demanding, and so more restructuring will happen. So it will be it was a bit passive, and I think it will be more active. And maybe I should start doing some restructuring advice.
Well, so let me ask you, well, I know you're on the capital market side, but for a bank, kicking the can down the road, have there been lessons? So the lessons is it was a good thing, is it a bad thing, or does it depend purely on the particular credit?
That is really case by case. That's really case by case, because sometimes time heals stuff. Sometimes market picks up, and you can come to solutions that didn't seem to be possible. So sometimes, well, it's interesting. It's again, it are people. People are hoping. It's difficult to take the pain, and people are hoping for stuff to pick up, and to which allow solutions. But it's just like you just heard. People are focused on we want this, this, and this, and that doesn't always work. But I would love to have banks to be more decisive, take more action, and be less passive. That's my personal view.
Okay, fair enough. One more topic before we wrap up real quick. Just what would the panel say would be the most important external factors that might affect the short-term, medium-term prospects for consolidation M&A? Floris.
The equity capital markets, that would be a major driver.
Sorry?
The equity capital markets.
Capital markets.
Yeah, that's the I think that's the main thing in M&A.
Markets overall, just the
Yeah.
general. Okay, fair enough.
I would say
Kevin.
I would say the financing support. You need to have the banks, the alternative capital providers, ready to look at a case where you're consolidating and get behind it. Because without the debt side, it's not going to happen.
Okay.
I would also say the equity markets, and to the degree that public companies in the space start trading at premiums to NAV, that will be a driver of consolidation.
Yeah, I agree as well. I think it's the equity markets and having real value and liquidity there, and the banks. If the banks were to pull back considerably, more than they already have, or pressure clients to do things that they haven't been pressuring them to do in the past, that would be, a big game changer.
Whether they respond or not is another question. Right. All right. I think we're just about out of time. Thanks to the audience. Appreciate your attention, and thanks very much to our panel. Appreciate it.
Thank you.
Thank you.